Got it. So that low, I mean, we're talking really the all-time low, aren't we? Of around about 86.
Yes, exactly. That's basically where that low from 2002 comes in, down around that 85, basically 85.66 is the low that we hit in 2002, and then if we go all the way back to 2000, there's a low down there at 82.32. So they would be some potential longer-term projections in the context of this trend reversal that we've just seen for the euro. Obviously, we would probably have to see much more significant negative developments in the eurozone to cause a sell-off to that extreme. But certainly, in the context of the bearish trend reversal that we've seen, it's something I think from a longer-term perspective that investors have to keep in mind here.
Okay, and the levels you've marked on here, we've got 1644. 765. Are these Fibonacci retracements, are they, or?
The 116.44 level is the low that we hit in 2005.
That's the previous low, yes.
Yes, and so that's what that corresponds to. And then below there, there's a reaction low that we hit in 2003 that comes in at 107.65 on the screen here. So those are a couple of very significant levels on the downside. And as we discussed as well, that reaction low from 2010 comes in around the 118.80 area. So that's also very significant in the context of the bearish trend reversal.
So what you're looking at is really previous levels. You're not looking at retracement levels.
That's right. Generally, what I'm focused on at this point is some relevant historical support levels that we've bounced off of in the context of the rally that we had been in since the early 2000s.
Okay, and the stochastic at the bottom, George, presumably that's giving us an oversold signal, a short-term oversold.
Yes.
Well, not that short-term, but does this point towards a kind of shorter-term correction out of this sell-off?
I think that is certainly a risk. We do have valuations that are starting to get quite stretched on a medium to longer term perspective. And also I think when you look at positioning, if you look at the IMM commitment of traders reports right now, we've seen a very significant buildup in short euro-dollar positions. So I do think positioning is generally one way, i.e. short right now. And certainly from a contrarian point of view, that does raise the scope at some point that we do see a fairly significant retracement phase. But as we discussed before, I still think the risks in that context are that if we do see a correction back up to that 10-year support trend line that we broke last month at 126.77, and then up around the 129 to 130 region on the top side, I think the market is going to view that as an opportunity to build short positions at better levels.
Okay. Do we have a triangle there? Is this actually a triangle breakout?
Yes, and that's the thing that's quite compelling as well about this recent breakout is not only have we broken below this 10-year support trend line that goes all the way back to 2002, but if we reference that trend line drawn off the highs from 2008 and 2011, we can also consider it the bearish downside breakout of a triangle pattern. So again, you're getting two similar signals. And the other thing that sort of stands out for me just in terms of pure price action is if you notice the price action since the peak in 2008, generally we've basically moved up to lower highs and lower lows as we've gone through this consolidation phase. And that's something else that worries me because that generally is a slight indication that we're starting to see a rollover in sentiment in the sense that the euro bulls who had been controlling the market from 2001 through to 2008 are starting to lose some of that influence given the fact that we're struggling to break above the prior highs. So that's also something that concerns me in the context of the recent price action.
Okay, so we're talking about quite a long-term change in sentiment here.
Yes, exactly.
I mean, looking at that triangle, would it be accurate to say that based on textbook triangle price projections from the breakout, that could potentially take us back down to the all-time low? That's the potential breakout, the projection.
Yeah, I think if you do look at it that way, that would certainly be a conclusion that's relevant. If you look at it, basically there's around a 50 big figure range between the bottom end of the triangle and the top end of the triangle. So certainly referenced off of that 126 area, that would definitely put us back down towards those lows and potentially below those lows from 2000 and 2002. So the measured move objective, again, this is a much longer term projection, but that's certainly one of the implications of this the breakdown that we saw last month. I think what we're seeing right now is the fact that the markets are being affected by the same thing or the same issues. What was kind of interesting to me when I looked at this relationship is if we go back to, for example, 2010, the euro bottomed out quite a significant period of time before 10-year bond yields bottomed out and started to move higher. Whereas if we look at what's going on in the current environment, for example, in 2011, when the euro peaked here close to the 150 level, that was almost simultaneous with a peak in bond yields. And we started to see, I think, that the fit of that relationship become a lot more tighter over the past year and a half or so. And of course, I think that all goes back to the whole Eurozone, Greece, and related type issues. And so I do think it's the same variable that's affecting both of these instruments now in the context of risk on and risk off. And so, for example, when we get these risk off types of tendencies, that tends to be a bearish environment for the euro. And of course, we get money moving out of the periphery into the core of the Eurozone, and that tends to have a depressing impact or a bullish impact on bond yields.
Okay. And just finally, George, that small short-term uptrend that you have on the bond chart.
Yes.
Over the last kind of year or so, how significant is that? How significant is that trend and the break below it? I mean, what is the significance of that?
I think it's very, very significant in the context of what's happening in Europe, because again, I think it goes back to this whole notion of the market slowly running out of patience in terms of a proactive, shorter-term solution to the problem, and not just stopgap measures such as LTRO1 and LTRO2, but an actual concrete solution to the problem. And I think when we started to see earlier this year bond yields basically break below the lows from 2011, below the 163 level here on the chart, that was an indication to me that we were starting to see the market lose a significant amount of patience. And what's interesting is when we look at the intermarket relationship for the two things, as bond yields broke below those lows from 2011 around the 163 level here, that was when Eurodollar started to break below this support area around the 127.70 area on the upper chart. So again, from an intermarket standpoint, we're seeing both markets break some very important technical levels at approximately the same time, which sort of adds a little bit of validity to the breakouts.